Global oil markets moved higher again as investors tried to assess whether the latest diplomatic contacts between Washington and Tehran could reduce one of the most dangerous energy disruptions in recent years. While political discussions have reopened, the key reality shaping prices remains unchanged. The Strait of Hormuz is still operating at near standstill levels, leaving one of the world's most strategic trade routes heavily restricted. Brent Crude traded close to $109 per barrel after a sharp gain in the previous session, while West Texas Intermediate climbed above $97. Those price levels reflect a market caught between two competing forces: hope for diplomacy on one side and a severe physical supply shock on the other. At the center of attention is renewed contact between the United States and Iran. Donald Trump reportedly held discussions with senior officials regarding a proposal sent from Tehran. However, Washington continues to maintain strict core conditions for any settlement, especially demands that Iran be permanently blocked from developing nuclear weapons capability. That means negotiations may continue, but a rapid breakthrough still appears uncertain. Although a ceasefire has generally remained in place since early April, the economic damage has continued because maritime traffic through Hormuz has not normalized. This waterway is one of the most important energy choke points in the global economy. Before the conflict, roughly 1/5 of global oil and liquefied natural gas exports moved through this narrow passage. Any prolonged disruption there automatically affects prices worldwide. The impact is not limited to crude oil alone. Refined fuel products, petrochemical feedstocks, and LNG cargoes are also facing delays or diversions. That creates a broader inflation risk because higher energy costs eventually feed into transportation, manufacturing, electricity generation, and household expenses across many countries. Market participants are currently relying on one important assumption: that flows will begin recovering gradually during May and June. This expectation has prevented even more aggressive price spikes. Traders believe that if shipping resumes within weeks, strategic reserves, floating storage, and alternate supply routes may be enough to bridge the short-term shortage. However, every additional day of disruption increases pressure. Inventories begin falling, freight rates rise, insurers demand higher risk premiums, and refiners compete harder for available cargoes. Once buffer capacity starts shrinking, oil markets often move sharply and suddenly rather than gradually. Iran's latest diplomatic position appears to include several conditions for ending the crisis. Reports indicate Tehran wants the U.S. naval blockade lifted, a new legal structure governing vessel transit through Hormuz, and guarantees against future military action. These are major demands and may be difficult for Washington to accept quickly. From the U.S. perspective, officials remain skeptical that Iran is prepared to meet core security conditions. Statements from senior American policymakers suggest Washington also rejects any scenario in which Tehran would preserve effective leverage over Hormuz after the crisis. That indicates negotiations could become lengthy and highly complex. Meanwhile, pressure inside Iran's own energy sector may be growing. With exports constrained and shipping access reduced, the country is reportedly running short of available storage space for unsold crude. If storage fills up, producers may be forced to shut wells or reduce output. Such shutdowns can be economically painful and operationally costly, especially if extended. This creates an important paradox in the market. Iran is one of the affected producers, yet the same blockade hurting Iran is also tightening global supply and lifting international prices. In theory, higher prices benefit exporters, but only if they can physically sell and ship barrels. For traders, the next move in oil now depends on three scenarios. 1. Diplomatic progress. If negotiations produce phased reopening of Hormuz, prices could fall quickly as risk premiums unwind. Brent could retreat sharply from current elevated levels. 2. Prolonged standoff. If talks continue without resolution while shipping remains blocked, oil may keep rising steadily as inventories tighten. 3. Escalation. Any renewed military confrontation or wider regional disruption could trigger a much more aggressive spike, potentially sending prices significantly above current levels. Financial markets are also watching inflation implications. Central banks worldwide had been moving toward easier policy in several regions, but another sustained oil shock could delay rate cuts. Higher fuel costs often revive inflation just as policymakers believe price pressures are fading. In short, oil is rising not simply because of headlines, but because one of the world's most vital energy arteries remains effectively constrained. Diplomacy has introduced hope, but not relief. Until tankers move freely again through the Strait of Hormuz, markets are likely to remain nervous, volatile, and highly sensitive to every political statement from Washington and Tehran.